Hi, and welcome to Esquire Group's webinar, the Foreign Earned Income Exclusion versus the Foreign Tax Credit. Which one is better? I'm your presenter. My name is Jimmy Sexton. I'm the president of Esquire Group. Just a couple of housekeeping matters before we get started. Your webinar interface has the ability for you to ask questions. Feel free to ask questions throughout the broadcast. At the end of the webinar, I will do my best to address all the questions that have been posted. I would ask that you keep your questions general in nature and not specific to your situation, because this webinar is being recorded and will be posting it on our YouTube channel afterwards. So we'll go ahead and jump in and get started. So we'll start off with a disclaimer. This webinar is for informational purposes only. This presentation was prepared for educational purposes only. This presentation is not legal or tax advice, nor is it to be construed as such. Each individual circumstances are different. You should seek legal and/or tax advice to address any specific questions you may have. Again, I'm your presenter. My name is Jimmy Sexton. I have a bachelor's in business administration with an emphasis of finance, a JD, and an LL.M in international taxation. I'm the president of Esquire Group. We have offices in Las Vegas, Phoenix, Vienna, Frankfurt, and the United Arab Emirates. We specialize in international taxation, including tax issues facing U.S. citizens and residents living abroad, expatriation, investing or doing business abroad, and foreign investment in the U.S. I'm fluent in English and German. So the first thing we're going to talk about is the foreign earned income exclusion. What is it? As a U.S. person, a U.S. person is a U.S. citizen, a U.S. green card holder, or somebody who meets what's known as the substantial presence test. And the substantial presence test is essentially where a non-U.S. citizen, non-green card holder can become a U.S. tax resident simply by spending too much time in the United States. So if a U.S. person is a foreign resident, they can exclude up to a certain amount of foreign earned income from U.S. income tax. The amounts are adjusted for inflation annually, so they go up a little bit every year. In 2015, the foreign earned income exclusion was $100,800. And in 2016, that number went up to $101,300. So that's essentially an amount of foreign earned income that a U.S. person that's a foreign resident can earn without having to pay U.S. income tax on it. So a couple of things that I think are very important to point out is that only earned income and only foreign income qualify for the foreign earned income exclusion, as the title suggests. So there's a lot of misconceptions that this is a blanket exclusion for foreign income in general. It's not. It's only an exclusion for foreign earned income. So foreign earned income is basically wages, self-employment, tips, basically money that you earned from working. Does not include passive income like interest, dividends, capital gains, royalties, things of that nature. So in order to qualify for the foreign earned income exclusion, the income has to be earned. It cannot be passive income. The income also has to be foreign income. So the question of what constitutes foreign income also can cause some confusion. So under the U.S. tax laws, the source of earned income is where the service is performed. So basically where you did your work, where you did your job. It's not where the money is coming from. So for example, let's say you were working in Austria for a U.S. company, and that U.S. company was paying you from the United States for work that you performed in Austria. Assuming you meet all the other criteria for the foreign earned income exclusion, that would qualify as foreign income because you did the work, you performed those services in a foreign country. So the next part of the equation is, what is foreign residency? So in order to be considered a foreign resident and qualify for the foreign earned income exclusion, you have to meet one of two tests, either the physical presence test or the bona fide residence test. The physical presence test requires, this is a little bit, that's the harder of the two tests to meet normally. This test requires you to be present in a foreign country or countries for 330 days in a 12-month period. A lot of people think that it's just being outside of the U.S. for 330 days, but it's not. It's being present in a foreign country for 330 days. So you have to look very carefully at the days that you are actually present in a foreign country. For example, the days where you're traveling to and from the United States don't count as being days spent in a foreign country. Likewise, let's say, for example, you were on a cruise and you were in international waters. That would not count towards your 330 days because you're not present in a foreign country. So it's very important that if you're trying to qualify as a foreign resident under the physical presence test, that you're really mindful of the days that you are present in a foreign country or countries. The other thing is that these 330 days being present in a foreign country or countries has to happen within a 12-month period. Now, a 12-month period does not necessarily need to be a calendar year. So, for example, a 12-month period could run from April 1st, 2015 to March 31st, 2016. And so if during that 12-month period you were outside of the present in a foreign country or countries for 330 days, then you would be able to exclude under the foreign earned income exclusion any foreign earned income earned during that 12-month period. The physical presence test is normally the test that somebody would have to qualify under in the first year that they move abroad, because most people don't move abroad on December 31st. And when we get into the bona fide residence test, I'll explain why that's important. The bona fide residence test basically requires you to have been a resident of a foreign country for an entire calendar year. And usually when people move abroad, they move sometime during the middle of the year, and so they couldn't qualify for the bona fide residence test. Although the bona fide residence test is the more lenient of the two tests once you qualify for it. So the bona fide residence test is a lot simpler than the physical presence test. It basically requires you to be a resident of a foreign country for an uninterrupted period that includes an entire tax year. So basically January 1st through December 31st. If you meet that criteria, then the days become less important. It's the being resident of the foreign country for an entire tax year that's the key factor with the bona fide residence test. So it's a lot more lenient because it's a lot less restrictive. You know, when we start talking about days traveling to and from the U.S., being in international waters, things of that nature. So in essence, if you meet one of these residency tests and you have foreign earned income, you can exclude up to the foreign earned income exclusion amount, which again for 2016 is $101,300. This is tied very closely to the foreign earned income exclusion. It's the foreign housing exclusion and deduction. Essentially what the foreign housing exclusion deduction is it's an additional amount of earned income that you can exclude from tax to help offset your housing costs in a foreign country. So if you were an employee, you'd get the foreign housing exclusion. If you were self-employed, you'd get the foreign housing deduction. The foreign housing exclusion deduction is in addition to the foreign earned income exclusion. So this gets added on top of that to give you an additional amount of excluded or deducted income. The amount of the foreign earned income exclusion is 30% of whatever the maximum foreign earned income exclusion is. So for 2015, it's $30,240. For 2016, it's $30,390, which if you take the maximum foreign earned income exclusion for 2016 of $101,300, you multiply that times 0.3, you get 30% of it, which is $30,390. If you are not a foreign resident for the entire year, then the foreign housing exclusion deduction gets broken down to a daily rate if you were not a full-time resident. Much like the foreign earned income exclusion, in order to qualify for the housing exclusion or deduction, you have to meet one of those two foreign residency tests, so either the physical presence test or the bona fide residence test. Even though the maximum foreign housing exclusion deduction is advertised, so to speak, at around $30,000, you don't actually get to exclude that amount of income because the IRS requires you to back out what is called the base housing amount, which is essentially 16% of the foreign earned income exclusion, or half of the foreign housing exclusion deduction. So if you figure you have a foreign housing exclusion deduction of $30,000, you're really only going to get to deduct around $14,000, not the entire 30. Some cities, the IRS has realized, are more expensive to live in than others, and so they publish higher limits for the foreign earned income exclusion or deduction for these high-cost locales, and those can be found online. Some of the expenses that qualify for the foreign housing exclusion deduction are your rent, utilities, insurance, things of that nature. One common mistake that we see is people try to claim their mortgage interest on a foreign property under the foreign housing exclusion deduction. That's not proper. That still gets deducted as an itemized deduction on Schedule A. So that pretty much covers the foreign earned income exclusion and the foreign housing exclusion deduction. So now we're going to move on to the foreign tax credit, which is another mechanism in the tax code to help offset having to pay double tax to the country where you're a resident and tax to the United States. And essentially what the foreign tax credit is it is a credit against your U.S. tax for foreign income taxes that were paid. The taxes, in order to qualify for the credit, the taxes must have been either paid or accrued during the applicable tax year. If you took the foreign earned income exclusion or the foreign housing exclusion or deduction, you cannot take the foreign tax credit on that same income. So essentially the foreign tax credit is lost for any amount that you excluded under the foreign earned income exclusion or the foreign housing exclusion deduction, because otherwise you'd sort of be double dipping. Any unused foreign tax credits can be carried back 1 year and forward 10 years. So this sometimes happens with people that live in, let's say, a European country where taxes are much higher than the United States is. They're usually going to pay more foreign tax than they would pay in the U.S., so they would have unused foreign tax credits, and those could be carried back 1 year or forward 10 years. So a good example of this, for example, is let's say you had somebody that was living in Austria for years where the tax rate is higher than that of the U.S. They would most likely have unused foreign tax credits because of the additional tax that they paid in Austria that was not credited in the U.S. because the U.S. had lower taxes. Now let's say that person decided to move somewhere like Dubai, where there are no income taxes. They would have those unused credits from Austria left over that they could use against their Dubai income to offset U.S. income taxes. That's a pretty simple example of how the foreign tax credit carry forward can be useful. There are special rules for calculating the foreign tax credit. So, for example, if you're an employee and you perform certain services and while you're in the U.S. on business, those amounts that were earned in the U.S. Don't qualify for the foreign tax credit. There is also a foreign tax credit limit. So basically, there's a calculation to determine what your maximum foreign tax credit is. That exact calculation is beyond the scope of this presentation, but just know that it exists, and you can't always get dollar for dollar credit for the foreign tax credit depending on that calculation. One of the things that I think is really important to point out, and this applies not only to the foreign tax credit but also the foreign earned income exclusion, is that the foreign earned income exclusion and the foreign tax credit only alleviate income tax, not self-employment tax. So self-employed persons have to pay an additional self-employment tax on top of their income tax in order to pay into most Social Security and Medicare. The foreign tax credit does not offset the self-employment tax. Likewise, the foreign earned income exclusion does not exclude self-employment tax. So if you're self-employed in a foreign country, regardless of whether you use the foreign earned income exclusion or the foreign tax credit, you would still be liable for self-employment tax in the U.S. on any self-employment income. Now, there are a number of countries that have concluded what are known as totalization agreements with the U.S. And essentially, if there's a totalization agreement with the country in which you're a resident and the U.S., you can obtain what's known as a certificate of coverage from the country where you're a resident. And that certificate of coverage would say that you're paying into and covered by that country's Social Security system. And then you could attach that certificate of coverage to your U.S. income tax, and that would exclude you from having to pay the self-employment tax in the U.S. because you would be paying in the equivalent in the foreign country where you're resident. So the question then becomes, what's better, the foreign earned income exclusion or the foreign tax credit? And like anything with the U.S. tax code, the answer is it depends. If you live in a country that has higher taxes than the United States, the foreign tax credit is probably going to be better because there's no reason to have to fall under those residency requirements and things of that nature for the foreign earned income exclusion, foreign housing exclusion, deduction, if you've paid sufficient foreign tax that it's going to completely wipe out your U.S. tax anyway. You might as well just take the foreign tax credit. It's a lot easier and a lot less fuss. The foreign tax credit is often better in the first year living abroad due to not being able to qualify for that bona fide residence test. So a lot of times, in the first year somebody's abroad, they can't qualify for either the bona fide residence test or the physical presence test. And then the foreign tax credit really becomes their only choice. If you live in a low or no tax country, then the foreign earned income exclusion and the foreign housing exclusion deduction is probably going to be a better option. So for example, going back to the example I was giving earlier, which involved Dubai, Dubai doesn't have any income tax. So the foreign tax credit wouldn't really do you any good because you're not paying any taxes there. So in that case, the foreign housing exclusion or the foreign the foreign earned income exclusion in conjunction with the foreign housing exclusion deduction would be a better option because you can exclude $100 and some odd thousand worth of income from U.S. tax. So that takes us to the end of our webinar on the foreign earned income exclusion versus the foreign tax credit. I hope that this webinar has been informational and that it's helped explain what the foreign earned income exclusion is, what the foreign housing exclusion deduction is, what the foreign tax credit is, what the differences between the two is, and where one might be advantageous over the other. I'd like to thank you for attending our webinar tonight. I hope you found it informational, and we look forward to seeing you in a future Esquire Group webinar.